So hello everyone, and welcome to Surfing the Rough Seas. I'm very excited to have this, I'm going to be the moderator of this panel, and we have some exciting panelists coming. You're going to hear their ideas right away. I hope it's going to be interesting. And let me start by saying that in this global entrepreneurial world, we have seen some tremendous rise in tech investment since 2013, reaching a tipping point by the end of 2021 with more than $675 billion poured into startups, and it doubled the previous all-time high of 340 just a year before, like 2020. So, and to give another sense of it, in 2013, we had around 40 unicorns globally. And by December 2021, the world was introduced to more than 1,050 global unicorns. So it gives you the sense of what we've been up to in the last, I would say, eight years. Now, that was last year. And currently we're seeing new trends and forces shaking the world, both for startups and active VC funds. And we see inflation and bear market and overall negative sentiment. And maybe even disbelief. And I think it's a good topic to talk about. And let me start by introducing myself. I hope you hear me okay. Yeah. So my name is Malamud. I'm going to be the facilitator here. I'm the founder CEO of FreshStart, a consultancy firm that work with founders and startups on the digital marketing and go-to-market methodologies, strategic partnerships, and investor readiness programs, mostly to improve their business outcomes and success rate. I'm also managing the Tech Investor Club, a deal-by-deal venture capital financial fund, where we match early-stage startups with private investors. And I've been engaged with the strategy tools for more than 2 years now. Whether it's a simulation facilitation and providing a solution on most of the strategy tools, portfolio and domains and activities. And I'm very, very happy to be part of this partner network and this smart and bright community, for sure. And I'm happy to let's start with introducing our dear panelists. And the first one would be Elin Hauge. Hi, Elin.
Hello.
Hi, and Elin is experienced AI and business strategist and professional speaker based in Norway. She has coached and mentored more than 300 technology entrepreneurs on pitching, business strategy, and commercialization. She also worked with a very unique platform and community, I would say, called Consilience Ventures, which I fund a lot. This is a tokenized venture capital and platform. She also involved in incubators in Croatia, and she is major part of our strategy tools network here. And I thank you, Elin, for joining this panel.
Happy to join you.
Thank you. Our second panelist would be Amine Tazi. And Amine is the founder and managing partner of AT Swiss, an early-stage VC fund focusing on SaaS, AI, data, cloud, and fintech domain. Amine has an extensive and proven track record of growing businesses, developing organizations, restructuring them, opening new markets in multiple industries, B2B, B2Cs, and multinationals and startups. He's also an M&A lead advisor with vast experience since his time at the Partner Europe till today. Great to have you here with us, Amine.
Thank you for having me. Thank you.
And last but not least, my dearest Dr. Musstanser Tinauli. And Musstanser is an early influencer in design thinking and smart cities since 2009. He's multiple times funded startups that focus on mobility, gig economy, and transformative deep tech. He currently spearheads the technology-driven mission in multiple startups, including Fori, Hayk, and Fori Missouri. Musstanser is a keynote speaker and deep dive design thinking workshop conductor. He speaks on environmental impact, future technologies, and scale. He has a charming, really charming personality, and I welcome him to our Strategy Tools Partner Network. Thank you for coming.
Thank you so much, Nir, for having me and for a very, very detailed introduction.
No, thank you. All right. So I'm eager to hear your opinion, on the current trends and the overall entrepreneur and VC landscape. And I think we'll start with Elin, then Amine, and then Musstanser. And Elin, so what do you think? What are the most critical changes that startups and VCs are expecting to face in the near future?
Well, I think the volatility in the global economy is going to have a significant influence, and I'm sure Amine can say more about that from his perspective. From a Norwegian perspective, I think that even though the capital markets slow down a bit, we will still need to innovate and do R&D and find new ways of solving the major issues of this planet. So I don't think we will see a market where the startup ecosystems die out. On the contrary, I think there will still be a need and a momentum for the startups and the innovations that will help us take this planet to a more sustainable future. But at the same time, maybe we get a bit more healthy attitude towards the capital. Also, this of course requires more from the entrepreneurs, but still there's a lot of space for the entrepreneurs. And again, I think that the entire volatility in the investor markets will make the requirements for the entrepreneurs a bit tougher, so that there is actually maybe a bit less space for the wild type of spending.
Who said crypto? Elin, I think we missed you. We're losing you.
Will trigger a lot of new need for innovation in Europe, and also trigger a lot of new ideas and new startup ecosystems to fuel that economy and help it back on their feet whenever the war ends.
Yeah. Oh, thank you. I mean, what do you say about that? I mean, what do you see from your perspective regarding these latest trends of maybe the VC point of view?
I think I'll start first from the startup perspective. I think startups are under tremendous pressure. Cash and profitability versus revenue growth become the day-to-day perspective. But I think in all crises, that's also triggers certain events, right? Is your corporate startup partnership going to be delayed? Do you have supply chain issues, as many are facing? Do you have enough stock? Talking operational, but I'm talking a little bit reality of what's happening on the ground. I think Nir, you alluded to inflation, which is a real big problem across the P&L of the different startups, but also for the investors, if you will. I mean, today, I think the key question for us in terms of entrepreneurship and VC today, and I think this panel is great for that, I think it's also an opportunity to stress out business models. Is the business model sustainable, or does it require a pivot? You will tell me some companies just did their pivot during the COVID crisis. Yes, that's true. But then you want to build sustainable companies and you're able to grow that companies properly. Just as a reminder, great companies were built during recession and downturn, and I can do a huge list of that. Yes, in terms of valuation have been discounted. Valuation will be further discounted. It started with late stage. Now it's reality as well in early stage. However, if you look at the VC ecosystem, you still see new trends coming up, right, from the other side of the table. Yes, you see some investor a little bit more hesitant nowadays. You see tensions between LP and GPs. You see new models powered by Web3 and DAO rising to redistribute value across the ecosystem. However, what you see as well is more and more evergreen funds popping up, which is pretty interesting. Why? Because the private market now will encourage that kind of model, that investors will have choice, that investors will have a different perspective in terms of distributions, in terms of fees, in terms of model that's not that they will have in a traditional closed funds. Last but not least, I think there will be more and more democratization of the VC. I think even with what all you depicted near, and I think that was a great introduction, I start seeing each day almost in your announcements of new fund being raised. So there is still money out there that can be used and will be used properly. The question is how you fuel innovation back to what Elin said and make sure that the companies that are already on a stride carry on their cruise properly to move on to the next stage. Thanks.
Oh, thank you. Thank you. Musstanser, what's your view on that? I mean, you've been in the, I don't know, in the middle of, I think, part of your work now is a fundraising, right? It's part of the thing. Well, what do you feel from the ground?
I think what both the panelists have said here is actually very true. The very interesting part is we are all aligned on sort of similar thinking. So I think that's a good start. You know the famous saying, go out and break things. It's still go out and break things, but it's go out and break things carefully. So we can't really speed up the same way we used to, because there's a cause and effect relationship out there. There are feelings, you have cash restraints, there's family pressure, and entrepreneurs are always under pressure. So it can't be game as yesterday. Some things have to change. And I really agree with Amine here, because the business models which are not working, they are dying out, or they're forced to go out. But really, this is a great time to build, because things are changing. It's not a drought out there, there's still a lot of money, but it's more traditional business sense. So you can't really say, we are going to have 2 billion users and then we would make this much money anymore. You have to have solid foundation where you have real traction, and it's just not, high church. So yeah, those are my views. So we don't really have to worry too much. I think the inflation and the economic meltdown, this is really, being a futuristic, but I don't see this lasting more than 8 to 10 months for startups in particular. I think if there's a solid business model out there, things will turn around.
All right. Thank you.
I just want to add one important trend that started late 21 and getting confirmed throughout Q1 and Q2. And I think this is a strong advice for entrepreneurs connected on the panel, but also for potential investors. You can grow from different way and formats, and we have quite great scale up here, specialists in the panel and also in the audience. But I think what is important in the game change is the rise in M&A opportunities. I start seeing more and more great companies coming with a short list of curated companies and having a view and a vision. I want to buy this company. So the message changed from I want to raise 3 million, I want to raise 5 million. No, I want to buy this company, and this is why 1 + 1 = 3. And in a downturn and a recession, this is super attractive. So upsides for ones, preparation for winners for the others. Consolidation on.
Yeah, sure. So thank you. And well, in my view, these changes really urge us all to strengthen our skills. maybe resilience and agility and these kind of skills. And I like us in our discussion to link it into maybe to the present, because we're talking in the, in the strategy tools ecosystem. So I like it to link it to the presence of advisor or a coach or a mentor or around founders. And some would argue that this is a luxury to have a paid mentor or coach. Other would, especially maybe during these times, and others must say that it's a must-have. It's a must-have to enable founders to think ahead, plan ahead, beyond the day-to-day, work. So I'd be happy to hear your view on that. So what's your view on a startup coach, or what KPIs would reflect the benefit of his services in a way that can convince potential clients, for the long-term value? Who wants to start? Open mic.
Okay, I can start. Nobody has raised a hand yet. So, this is something very, very, very important. This is crucial to a startup success. There's a Newton saying, right? I stand tall because I stand tall on the shoulders of many who came before me. So having a great coach means a lot, because you can get the right advice. Because as an entrepreneur, especially if you are in the, if you're one of the founders, you're making decisions about things that you have not done before, that you have not seen before. So you have to guesstimate really that, is this the right path? So having access to a coach or a mentor, I want to add a little detail into what sort of coach or mentor you should be having. But having that access can change a lot of things, because you can learn from their experiences. But if they have done that before, in the industry, you would see also a lot of coaches who do not necessarily have, let's say, startup experience, who have a lot of very strong corporate innovation experience, which is, of course, not to discount how important that is, but it's different. Sometimes entrepreneurs just need, a little bit of pat on the shoulders and someone who believes in them. That's enough. But that's not always enough. So I think you need specialized coaches. So if you have mentors, coaches, you should have specific roles set for them. And I agree with you, there have to be KPIs, because if coaches are opening their time, they're spending time when you're sleeping, they're really thinking ahead. Because if they already went through a slope and then you coach them, it's already too late. So I think there has to be proactive coaching here, very specific to what skill sets they offer. So this is sort of my view. I think the fellow panelists can add if they agree or they see this differently.
I would say that I think it's a great role more than ever currently with the current situation. I think it starts first by who is the prescriber. And I really want to highlight this point. If you're working for the CEO and for the board, or if you're working for the investors, right? That's the first question we should ask ourselves. I think it could be of great standards and great inputs provided to the company. I mean, if everybody's interested about the benefits of the company, first of most, but some people misjudge the role or don't like the role and the impact it has. And I think what Musstanser said, it's brilliant, because it starts by alignment of interests about an objective you want to achieve through that coaching. So picking the expertise, picking and building the trust. I think that second keyword is important, because if you are here to open up the eyes of the CEO and its management and help him in a neutral way, and the keyword is neutral, right? To build his long-term funding roadmap, to make his choices, to select his investors, to drive and find his journey properly, right? And you're mandated by this gentleman and his team, right? That's a pure alignment of interest. Yes, they should be KPI. I 100% agree with that. And they could take different form and formats. If you look at the private equity model, it's it's important to have milestones associated with it, and basically the embracing of the action plan, because you derive an action plan together and its execution, okay, should match that kind of milestones. And I think that's kind of skin in the game, which is one of my favorite books. And I think it's very important to put that in perspective. But you should not make the coach wear different hats. You need to maybe scope things properly on that, right? So some people start discussions, etc., and it's evolved to other things, right? I just recall one important discussions, which I think is very important, where the VC was the prescriber and he would not necessarily align with basically the recommendation, because basically you are going to restructure the cap table in a way that was not sitting his purpose. So that's why I think it's very important you think about it and think about how you would position it. But still, I think in the scale-up journey, what is, I think, brilliant, it's the second part is the coach. And coach implies there is coachability. So there is, you know, a recipient to receive that coachability. And sometimes, back to the alignment, it has to match. They should be chemistry, they should be alignment, they should be, I don't think near you will put a KPI to answer on that, but it should kind of be the foundation of making it happen. Thank you.
Chemistry, in a way.
Okay, so then I will throw a couple of firecrackers into the party here. I've talked to a lot of entrepreneurs over the last few years, some hundreds, and I've seen quite a few mentors, worked with quite a few incubators and accelerators. And this is a double-edged sword. So I see that many startups, they expect, or maybe they are even being trained to by the accelerators to expect that the mentors work pro bono. And in the incubators and accelerators, very often they do, and there's a reason why they do. But that is not necessarily a healthy expectation over time. Because why, you need to ask yourself, why does a mentor accept to work pro bono? Because there's never such a thing as a free lunch, even as a mentor. So you have a reason why you do it pro bono. So usually it's one out of two. Either you do it because you want to get some kind of being recognized in the startup ecosystem for some reason, or you are scouting investment opportunities, right? So from an entrepreneur side, if you're going to have a mentor with one of those two intentions behind being a mentor, what are the implications, right? Because very often then you end up with somebody doing this either with their left hand, their left pinky finger, or only for a short period of time, which for a lot of incubators and accelerators is fine, because the entrepreneurs only need a couple of hours of discussion and mentoring and sparring, and that's fine, that's okay, right? But you need to understand, why do they work pro bono? Because if you want to work with a long term, there is no such thing as pro bono. And that, then we come to my other firecracker. I'm sorry to say that I'm one of these mentors myself, but I do see some of the players that are not VCs and not entrepreneurs behaving like sharks, because they see that the whole startup ecosystem has been sizzling hot, right? There's a lot of money, there's a lot of attention, there's a lot of fame and glory if you're part of this ecosystem. But they're all trying to make money out of either the VCs or the entrepreneurs by being a part of this, either by referring, taking a commission, getting a sweat equity, and sometimes that's really fair. Sometimes it's not necessarily fair. So I think the entrepreneurs should also be very careful with which entrepreneur or which coaches do they choose for which purposes. Like Amine and Musstanser also says, why do you use this coach for this purpose? To me, having worked with so many entrepreneurs and on very specific topics, because for many of these, my role has been to coach them on the pitching skills, which is my a very specific path, right? But I think, at least for myself, it's very much about the respect for the individual entrepreneur, because there's a reason why they're in this very specific position. It's not because they needed a vacation, right? They are working so hard to achieve something that they have envisioned for a long time, that they're really passionate about, which means that these entrepreneurs, they have some very strong capabilities. My role as a mentor is not to go in there and tell them how to run their company, because a lot of what they're doing, they know so much better than I do. So that's like the respect side to it. So now I talked about the compensation, the sharks, and the respect. And coming back to this compensation side, the pro bono. So the alternative to that is to look at how do you actually somehow manage to pay a mentor. Usually a startup doesn't have funds to pay a mentor over a long period of time, because they're usually a bit expensive resources. And that's where you see companies like Consilience Ventures coming in with the tokenization of equity, which means that they are somewhere in between getting paid and sweat equity. So it's sweat equity, but you get paid in tokens, so you get paid on exit, right? So I think the market will find new ways of solving this sweat equity part of being a mentor. Yeah, that was a long rant from my side.
but a beautiful one, and I must say that I second your view on the tokenization part. I think it has some maturity phase to go through, but it is the right path in a way, because it solves this funding problem of good resource of knowledge and skills, and this is a way. All right, so watching at the clock, and since we were chunked, I mean, our time got chunked a bit from the previous note speakers. So let's do this really briefly. I want to shift our discussion a bit to the CVC world and the corporate innovation. And basically the reason for corporates to go into a CVC fund, I would say, is mostly to disrupt what's core and known. They should shift their businesses, or at least aim for a future that broaden the business portfolio. And this is usually, I know most of the strategy tools partners are familiar with the minimum innovation strategy, which outlines a framework of 5 pillars. One is build, buy, partner, co-invest, and co-develop. And I would say that the CVC is really the pillar of co-invest. And the role is to source potential deals, identify opportunities, invest and create value for these investments. Now, I'd like to elaborate a little bit, like we have like 5 or 6 minutes, and then I want 1 or 2 questions with the time left. So what would be the best way to sell entrepreneurship as a mindset into a corporate? What would it be? Like, let's start with Musstanser, please. I know you're coming from the entrepreneurial world, but
I was like, oh boy, you know, there's an elephant in the house. Okay, look, so just because people in a certain organization aspire or fancy or envy entrepreneurship, that doesn't mean they adopt that culture. And that also does not show their readiness to adopt that mindset. I think this is the most, for me, having worked with corporates as an entrepreneur, or even as, you know, an MIT guy when I was there, they have different expectations. So we first and foremost, we have to segregate completely. Is this for corporate innovation? Their end goal is to continue or sustain their business growth. And, you know, they don't have this mindset of insane amounts of scale and growth within 6 months. You know, they don't look at that. They would go steady, solid. You know, I have a way of explaining this. I say big corporates are like elephants. They go where they want, when they want, and how they want. Mm-hmm. So if you're an entrepreneur, you run as fast as you can around them to get benefit out of their current standing and positioning. Now, So I think this is my core message here, really, that segregate what you expect from a corporate.
Yeah.
One more quick thing on HR side of this. I think if corporates really wanted to innovate the same way startups and entrepreneurs do, let's say 20-30% of the assessment of the employee has to be based on what practical impact or collaboration they had with startups. So this would be my short way of doing that.
Thank you. Who would like, Elin? What do you say?
All right. So I've spent about a bit more than half of my career in the corporate world and a bit less in the startup world. And just one single tip to the entrepreneurs is really understand what are the decision criteria of the corporates. So I worked in the insurance industry, and when I come across startups trying to innovate in the insurance business, most of them don't understand how an insurance company makes decisions on innovation and business development. And then they can try to sell as much as they want, but they will never get through. So main message is really understand how the corporate makes decisions.
Yeah. And if I may add to that, some of the organizations that do want to go or do invest time, resources, money in CVC, not necessarily build a planned path, a journey, a strategy regarding this. So they start, they kind of experiment things, they engage with startup, they want to go that path, but it's not structured well. And this is a major point that I don't see how startups sometimes can identify it before they get engaged with these corporates. And not sure there are KPIs related to success on that manner. Sometimes, by the way, the KPIs or success regarding this is more of a personal KPIs of the people inside the corporate that are getting, involved rather than, whether it's reaching to new technologies. It is outlined out there, but not necessarily this is the right KPI that drive the whole thing. So
it is literally outlined, right? It is right on the edge of their portfolio.
Sure.
This is the life of a startup. And then you're trying to compete and match and correlate with something which is just, a bullet point. So there's a lot of work, I think, that has to happen.
Agree. Amine?
I think I'm going to be a little bit provocative on this one. Been sitting on both sides on the fence, and without quoting any big multinationals, I think you can start simply asking the first question to baseline your starting point is, what is the last innovation you've done? And you will see the answer. And you will see the denial of not invented there. You can take another question and that be a little bit a better starting point if you are doing whatever form of corporate venturing, venture builder, whatever, before even you get there. What is the highest risk you have taken? And what do you accept as a failure? You pile up these three questions, you know how gap is the wide gap you have in front of you, and you have quickly an idea of the reality of whatever form of intrapreneurship, etc. I can save the part of the answer to tell you what you need to do next, but I just want to start with these 3 points because for me, it's really eyes opening, and sometimes I'm going to just push even the bottle a little bit further, there is an investor communication or roadshow, and big R&D organizations, right? Hey guys, what can we announce? We don't know, right? So just let's pause a little bit. So the guy or the lady that's going to take up whenever a new entrepreneurial business unit not only have to have the mandate, but need to make sure that the contribution of the new business unit they are building is really clear, outlined, highlighted, contributing to the direction of the company. Everybody knows about it. The resources are allocated right? And then we can speak about the complexity of the structure if you want another time.
Right. Thank you. First of all, thank you all, my friends, I must say, our panelists. It's been a great discussion in my view. I hope everyone enjoyed it. I do want to have last question from the audience. And Florian, you asked, and I like your view, panelists, regarding this. So is sustainability, or our sustainability must-have, help FreshStart to serve the RFC, or is it a barrier? Do you understand the question? I mean, please, Musstanser.
Okay, I think I do follow. I would love the other panelists to answer as well. You know, I think even corporates have realized something, even those companies that dig just petroleum out of the earth, that there has to be a triple bottom line strategy. Otherwise, there is no future. So it's people, planet, and profit. So it would be a lie if we said people move from the planet first. They have to see profit first. So that's their first vertical. Then it's the planet, because without planet, there won't be anything either. And then it's the people. So I think any company, any corporate, any startup now coming and launching without this strategy in mind, I don't think they can do well. You know, given how bad we are with everything, you know, the COP26 happened a few months ago, and the environmental situation is bad, and there's a lot that needs to happen. And that's why there are so many funds coming up, you know, there are a lot of investors out there who want to contribute. So in my perspective, it's a must-have if I have to answer this straight.
Thank you. Please, Elin.
Well, yeah, I completely agree. And then I would throw in a couple of firecrackers here as well. That's what a panel discussion is for, isn't it? I have seen quite a few demo sessions of startups who claim to be sustainable this, sustainable that, where I think that idea should die because it has nothing to do with a sustainable future. It's just greenwashing, right? So we need to make sure that it is real, that it is actually helping the planet and the world a few steps towards a more sustainable future.
Right.
And the other side, one more thing, we tend to forget that digital is not necessarily sustainable. We tend to think that any digital transformation that can argue that we're solving the UN sustainability goals is great. It is not, because the processing of data requires electricity. The world, at least in Europe, we're getting into a rather significant electricity problem in the coming few months, right? So just fueling whichever technology and thinking it is sustainable doesn't really work. We need to think how much processing and powered by what. And the other side to it is that anything digital has some kind of hardware end or beginning, whether it's a smartphone or a computer, or there's a server somewhere, or there are digital devices or goggles or sensors or whatever. All those hardware elements, they have real environmental footprints. And we need to take that into account as well. We can't just make some gadget digital and then think we're all good. We're not.
Yeah.
Right. Thank you. I mean, mind the time. I'm
going to be short and sweet as usual. I think corporates and also fund and investors understand that there is no brainer about sustainability. Now, many of them are rolling over the sleeves, trying to implement what does it mean, and both in their investments, in their reporting, in terms of it. So yes, to answer the question, there is an opportunity if it's resolved and help the ecosystem one way and the other, either to measure, to help, to reduce, etc. And I see a lot of great companies already started making good stride on it. I think just to the point on Elin, because I think I just want to make it really clear. Digital needs to be measured with the net impacts, means just to make sure that you will have spending, you will have waste, but you need to measure net impact. And I think there is a lot of opportunities just to rise. When you see now people talking about new type of trading because of sustainability, where people talk about reinventing again business model because of sustainability. That's, I think, what should be the attention, you know, and changing habits of customers and consumers will take time. Thank you.
Right. So thank you very much.